Hey everyone! So last week the July CPI inflation numbers were released and they were pretty much in line with economists' expectations. Headline inflation remains at 2.7% on a year-over-year basis, while core CPI inflation rose by 20 basis points to 3.1%. Although both of those numbers are still higher than the Federal Reserve would like to see, and they are trending up a bit, they're really not showing a material impact from tariffs yet. The annualized 3-month inflation trend is still landing in the upper 2% range for both headline and core inflation, and looking at the month-over-month movement of specific subcategories, they didn't show any substantial spikes. Now, it's widely believed that an inflation surge is still out there. The chief economist of Goldman Sachs recently said that U.S. consumers have absorbed about 22% of the tariffs through June and will eventually absorb 67% of the tariffs as they come through. He also predicted that core inflation will climb to the mid 3% range. Reinforcing that point on who's paying the tariffs, if you review the corporate earnings reports from the second quarter, many companies cited significant tariff-driven cost increases, and several companies indicated they're going to pass more of the tariff costs through to consumers. But the impact just hasn't shown up in the July inflation data in a material way. One more inflation release will come out before the Fed's next decision on September 17th. But at this point, considering the signs of a weakening employment market that emerged in the last round of jobs numbers, there would likely need to be a substantial inflation movement in the September 11th Consumer Price Index report for the Federal Reserve to hold rates at their current level. So the broad-based assumption at this point is that the Federal Reserve will reduce rates by 25 basis points on September 17th. Currently, Wall Street is placing more than a 90% probability of that cut. In addition, Wall Street is assigning a 71% likelihood of another rate cut on October 29th and a 60% chance of a third cut on December 10th. But again, I want to remind everyone that cuts to the overnight rate do not always translate to declines in the 10-year Treasury rate. We experienced that last year when the Fed rate cut spurred a surge in the 10-year Treasury rate. But for commercial real estate, any signs of downward pressure on interest rates is a positive. The slim margin between the 10-year Treasury and cap rates has slowed investor activity. And even though national average cap rates remain elevated across all property types compared to the market peak in 2022, the spread between the cap rates and the Treasury rates is still pretty narrow. Now, based on the RCA hedonic cap rate metrics, which try to account for variances in the composition of the deal flow, office cap rates are up by 20 basis points in the second quarter from a year earlier, reaching 7.7%. Industrial cap rates are also up by 20 basis points to 6.4%. Retail cap rates held steady from a year earlier at 6.9% nationally, and apartment cap rates were also stable, coming in at 5.7%. We're seeing a little downward pressure on apartment cap rates in a handful of markets, but the momentum is still relatively isolated and marginal. But from what I'm hearing, if interest rates and the cost of debt capital comes down over the next few months, it could unlock additional investment capital and potentially begin to put downward pressure on cap rates. So, looking forward, if investors agree with Wall Street and believe the Fed will cut rates by 25 to 75 basis points in the next few months, and that translates to a lower cost of debt capital, then deal flow could accelerate in the coming months, which suggests that now might be the opportune time to prune portfolios of weaker assets, and investors may want to begin scouring the market for potential acquisition targets. Although these are shorter-term trends, we may be entering the transition to the next commercial real estate investment cycle. And getting active now could pay dividends for investors who keep their eyes on the horizon.